Welcome. Today we're going to be looking at quite a mix of things happening around May 19th, 2025.
That's right. We've got rising U.S. Treasury yields, the Moody's credit downgrade for the U.S., and, well, how all of that is shaking out in the crypto markets and for mortgage rates, too.
Exactly. So we'll unpack why yields are up, Moody's reasoning, the market reactions, bonds, cryptos, and then shift to mortgage rates, what's driving them, and what the experts are predicting.
It's a lot of interconnected pieces.
Definitely. And if you want to stay on top of analyses like this, do consider subscribing.
Okay, so the yields first. The 10-year Treasury yield, it's pushed past 4.5%.
And the 30-year even touched 5.0% briefly, right?
It did, yeah. And a big part of this seems to be a shift towards risk-off sentiment. General macroeconomic uncertainty playing a role.
Amplified, I suppose, by that Moody's downgrade.
Absolutely. Moody's took the U.S. rating down a notch from AA to AA1.
And what was their core reasoning for that move?
Well, they pointed mainly to the increasing government debt levels.
Right, the sheer amount of debt.
Yeah. And not just the amount, but the rising cost of actually refinancing that debt as rates go up.
Makes sense.
They also mentioned expectations of, well, larger deficits going forward. You've got entitlement spending rising, but government revenue is projected to stay pretty flat.
Okay, so that's the backdrop. Now, how did the crypto markets react to all this? We saw some significant volatility.
We certainly did. A noticeable pullback across the board, really. Bitcoin, Ethereum, they both felt it.
It really highlights how linked these markets are becoming, doesn't it? Traditional finance like treasuries and digital assets.
Exactly. That interconnectedness is clear. One of the big risks here is liquidity drying up a bit.
As institutional players maybe move towards safer assets.
Precisely. Reallocating capital, which could, fuel a bit of a short-term bearish trend in crypto.
But are there potential upsides or opportunities?
Well, possibly. If Bitcoin can sort of hold its ground near $65,000 and maybe Ethereum around $3,400, some longer-term investors might see those as potential entry points.
Interesting. And what about altcoins? I heard some, especially those in DeFi, saw even sharper drops. Why is that?
Yeah, things linked to DeFi and yield farming definitely felt it more. They're just inherently more sensitive to interest rate changes.
How so?
Because, well, a lot of DeFi is built on lending and borrowing, right? So the cost of capital, influenced by things like treasury yield, directly impacts their attractiveness and potential returns. Higher yields elsewhere make DeFi yields look relatively less appealing.
Leading to more selling pressure there. Got it.
Yeah.
Now let's look at some technicals. Bitcoin's RSI dropped to 42, Ethereum's around 40. What do those tell us?
Okay, so RSI, Relative Strength Index, usually below 30 is considered oversold, suggesting maybe a bounce is due.
And we're not quite there, but getting closer.
Right. 42 and 40 indicate, well, significant selling pressure, but not extreme oversold territory yet. For Ethereum, the AMKD, another indicator, was showing bearish momentum, suggesting the downward trend might have a bit more steam short term.
We also saw a 12% jump in Bitcoin outflows from exchanges. What's the thinking behind interpreting that?
Generally, when you see Bitcoin moving off exchanges into, say, cold storage, it's often seen as investors planning to hold long-term.
Dilling, as they say.
Exactly. Less about near-term trading, more about securing assets for the future. Could mean they expect prices to rise later or just want to ride out the current volatility securely.
And that correlation figure, the 30-day rolling correlation between Bitcoin and the S&P 500 sitting at 0.65, that seems quite strong.
It is, yeah. 0.65 indicates a pretty strong positive link right now. It suggests both markets are reacting to similar big-picture economic factors and sentiment.
So in this risk-off mood, both stocks and crypto are feeling the pressure.
That's what it looks like. Bitcoin behaving much like a traditional risk-on asset in this environment.
But interestingly, spot trading volumes for Bitcoin and Ethereum actually declined by about 10%. Why would volume drop amidst the volatility?
It could just be retail traders getting a bit hesitant. Uncertainty kicks in with rising yields, the downgrade news. Some people might just pull back, wait and see, rather than actively trading in choppy waters.
Okay, let's pivot to the bond markets themselves. Reports said investors were dumping long-term bonds. What happens then?
Well, the immediate effect is what we saw yields go up. When people sell bonds, the price drops and the yield moves inversely.
Pushing those 10-year and 30-year yields higher.
Exactly. And that kind of selling can spill over, creating nervousness in other areas, like stock futures falling, for instance.
There was mention of a potential dangerous bear market spiral in bond yields. That sounds ominous. What does that mean?
It refers to a kind of negative feedback loop. So selling pressure pushes yields up, which makes servicing the national debt more expensive. Concerns about the debt and the downgrade might fuel more selling, pushing yields even higher, maybe weakening the dollar. It could become self-reinforcing.
It's interesting because normally higher yields would strengthen a currency, right? Attract capital. But there seems to be doubt about the dollar here.
That's the counterintuitive part. Yes, higher rates usually boost a currency, but why the rates are rising matters. If it's driven by worries about the country's fiscal health, the debt load, the credit downgrade, that can actually undermine confidence in the currency.
Offsetting the yield advantage.
Pretty much. The underlying concerns are weighing on the dollar, it seems.
ECB President Christine Lagarde actually commented on this, calling the dollar's decline against the euro counterintuitive. How did she explain it?
She basically suggested it reflects uncertainty and maybe a bit of lost confidence in U.S. policy direction in some parts of the market. The bigger picture worries are, for now, outweighing the simple interest rate differential effect.
But the U.S. Treasury Secretary, Scott Bessent, seemed to downplay the Moody's downgrade itself.
He did. He called it a lagging indicator, suggesting it doesn't really capture the current economic strength or the administration's efforts on spending and growth, trying to reassure markets, essentially.
What about other countries? China reportedly cut its U.S. Treasury holdings back in March. Is that significant?
It's always watched closely when a major holder like China reduces holdings. However, some analysts think it might be more about adjusting the duration of their portfolio, holding shorter-term debt to be less exposed to rising rates, rather than a full-scale exit from the dollar.
So not necessarily a rejection of U.S. debt altogether.
Maybe not. And it's worth noting that overall foreign demand for treasuries apparently remains strong in March, so the picture's a bit mixed there.
Okay, let's think about how these higher borrowing costs, driven by Treasury yields, might affect consumers, maybe through technology costs.
Yeah, that's a potential knock-on effect. The tech sector, especially hardware makers, often needs a lot of capital for R&D, manufacturing.
Capital intensive, right?
Exactly. So if their borrowing costs go up, it can squeeze them financially.
And what could that mean for us, the consumers?
Well, a few things. You might see investors get a bit jittery about tech stocks. The companies themselves might have to tighten belts. Maybe product launches get delayed, or perhaps prices go up to cover those higher financing costs.
Slower product cycles or pricier gadgets?
Could be. And service providers, maybe streaming services or software companies, they might get more aggressive trying to push users onto premium paid tiers to boost revenue.
Even things like financing options for big purchases.
Yeah, those buy now, pay later or store credit options for electronics might become less generous or harder to qualify for, or just disappear in some cases.
Okay, shifting gears now to mortgage rates. We saw some ups and downs in mid-May. Can you walk us through the recent trend?
Sure. So looking at the 30-year fixed rate, on May 15th, it jumped up to around 6.87%. Then it nudged up again slightly on the 16th to 6.85%.
Likely reacting to those rising Treasury yields and the downgrade news.
Very likely, yes. Increased uncertainty, inflation worries often push mortgage rates higher. But then, interestingly, on May 17th and 18th, the rate actually dipped back down to 6.77%.
A bit of a pullback. Why might that happen?
Could be a market correction after the initial spike, maybe some stabilization or perceived stabilization in the bond market, or perhaps some economic data came out that eased inflation fears slightly. These things move day to day. The 15-year fix followed a similar pattern, by the way.
There was also that weird day, May 14th, where adjustable rate mortgages, ARMs, were actually higher than fixed rates. That's unusual, isn't it?
It is quite unusual. Normally, you get a lower initial rate on an ARM as compensation for taking on the risk that the rate will adjust upwards later.
So what does it mean when the ARM rate is higher?
It often suggests lenders think rates might actually fall in the medium term. So they price the initial ARM rate higher to kind of protect themselves against borrowers refinancing out too quickly if rates do drop. It reflects uncertainty about the future path of rates and Fed policy.
Interesting. What about the forecasts? We have predictions from Fannie Mae, the MBA, the NAHB. What's the general feeling about where mortgage rates are heading?
The general consensus seems to be a gradual decline over the next year or so into early 2026.
A decline, okay. But how much?
Well, the forecasts vary a bit. Fannie Mae is maybe the most optimistic, seeing the 30-year fix potentially getting down to around 6.1% by Q1 2026.
And others?
The Mortgage Bankers Association, MBA, and the National Association of Home Builders, NAHB, are a bit more cautious, maybe seeing rates closer to 6.6% around that same time frame. U.S. News, Freddie Mac also generally predict a slow drift down, but likely staying in the mid 6% range through 2025 and 2026.
So relief, but perhaps gradual relief. The report also mentioned rates varying state by state. Why is that?
Oh, yeah. Rates aren't uniform across the country. It depends on things like how many lenders are competing in a state, specific state regulations, the average credit scores of borrowers there, typical loan sizes, and just different risk strategies by lenders in different regions.
Lots of local factors. And just to recap, what are the big economic levers that generally move mortgage rates up or down?
The main ones are really the bond market, especially that 10-year Treasury yield we talked about earlier. Mortgage rates tend to track it closely. Then there's Fed policy, of course, overall inflation levels and expectations, economic growth figures, and just the general level of competition among mortgage lenders.
So putting it all together, this surge in Treasury yields, the U.S. credit downgrade, they're definitely sending ripples out across the financial world.
No doubt. Affecting crypto, bonds, potentially tech costs, and clearly hitting consumer borrowing costs through mortgages.
It really shows how interconnected everything is. And the mortgage rate fluctuations, the different forecasts, it just underscores how dynamic the housing market is right now within this whole economic picture.
Absolutely. And that weird ARM rate inversion we saw, it's a small detail maybe, but it really speaks volumes about the level of economic uncertainty out there.
It makes predicting the future path quite challenging.
Extremely challenging. It really serves as a reminder of the anxieties in the market and how everyone's trying to anticipate the next move in interest rates.
Well, it's definitely crucial to keep monitoring these developments and think about how they might shape financial decisions moving forward.
Couldn't agree more. Staying informed on how these pieces connect is really key in navigating this kind of environment.
Thank you for walking us through all of that. A lot to keep an eye on.
My pleasure. Always interesting times.
And thank you all for tuning in. Remember to subscribe if you'd like to join us for future analyses.